Hello, this video is about some of the basics of company accounts. Now the first thing to note is that the capital, which in a sole trader we just note as an amount of capital, in this example £1 million. Now that in a company this would be divided up into shares, into individual shares. So we could have 1 million £1 shares. So each share is valued at £1 and there's a million of them. So when the company raises its money, either one person or a number of people buy some of those shares or all of those shares at £1 each, the company would raise £1 million in capital. Or it could be, and we can have different values for the shares, initial values. It could be that it's 4,025p shares, and the company can decide what nominal value it has for its share. This is the nominal value, and that's the price at which the shares are first issued. Okay, so the share capital is divided into shares. Obviously, an individual with more than 50% of the shares, i.e. more than 500,000 £1 shares in this first example here, they would have control of the company. They could outvote any other shareholders, because in a company the shareholders can vote for to make decisions and decide on what the companies will do. Now of course, once you've bought your shares, then hopefully the company will grow and make profits and bigger profits in future years, and then the shares are bought and sold on the stock market, and the share value can go up and down, and of course they can go to zero if the company goes bankrupt or does badly. The shares can fall in value, and that's called the market value of the share. So the price at which you can sell the share in future would be called the market value, which is the price that's shown on the stock market for those shares. But as far as the company is concerned, it's the £1, the nominal value is what they actually get when they raise the capital for the company. Another important point to note on companies is that the shareholders have limited liability, which means that their liability is only limited to the amount of shares that they've purchased. So if you've bought 1,000 shares, 1,000 £1 shares in this company, that's all you can lose. You can't lose any more than the shares that you've got. If the shares go to zero, you're not going to get any money back for your shares, but you can't lose any more. Now in the past, owners of companies can lose more than the value of the company. If the company's got debts, then the creditors can ask for your house, your belongings, etc., to be used to pay off those debts. With limited liability, you've got shares in a company, you can only lose the amount you've put into that company. Okay. If we go on to the next sheet, we've got dividends. Now, if you own shares in a company, you will be paid dividends, and that's the name for your share of the profit, the share that's given out to shareholders. So you'll receive a dividend, and that's often calculated as a percentage of the nominal value of each share. So always taking this nominal value, the £1 shares for instance, you might be told that the dividend will be 10%, a dividend of 10% on your £1 share. So you'll be basically getting 10 pence for each share that you hold. And that would be your dividend, your share of the profits. That's the way it's given out. Types of shares. There are lots of different types of shares. The idea, of course, is that a company wants to raise money, and in order to attract different types of people into buying those shares, it has to offer different types of shares which would suit their needs and be attractive to them in order to ask them to put money into the company. We can have ordinary shares. Now these are the normal ones, if you like, and the main thing there is the holders of ordinary shares can vote. So they can vote on the decisions of the company, and they are effectively the owners of that company, so they can vote. But the other important factor for those is there's no fixed dividend. So if the company doesn't make a profit or makes a low profit, they don't necessarily get a dividend. They're not guaranteed a dividend. But of course, if the company does very, very well, they could get a very big dividend. So their dividend is not guaranteed. Now another type of shares which will appeal to the more cautious investor is called preference shares. Now on these, they don't necessarily get a vote in normal circumstances, but they do get a fixed dividend. So maybe it's a preference share with a 6% dividend. So every year they will get 6% of the nominal value of those shares. And it's called preference because they will be paid out before ordinary shareholders. They have a preference on the profits of the company. So they're always paid first if there's any profits. Now, if there's no profits, they won't get a dividend, but they will get the first call on any profit that there is. And usually, of course, where there's profits, they will at least they'll get their fixed dividend. Now, there are different types of preference share. There are some called cumulative preference shares, where if they don't get the dividend one year, they'll get that in future years. So, important thing there are different types of shares. Ordinary shares are the normal ones, and there's many types of shares to attract different types of investors. So that's one way in which a company can raise its money by issuing shares and getting people to buy those shares and thus become owners or investors in that company. Now, the other way is to simply borrow the money. We could borrow the money, or we could issue shares. So they're the two ways of raising money for a company: to borrow and to issue shares. We call that, and often in textbooks you'll see, they're called debt or equity. Debt or equity. The two different ways of raising money. Now, the advantage of borrowing is if you borrow money from the bank or financial institution or other companies, you don't lose control of the company because they're just lending you the money and all you have to do is pay them back. But you do have to pay them interest. Now, that's a disadvantage. Obviously, you've got to pay interest if you borrow money. The disadvantage is here, it's in comparison to shares, if you like, is that if the company is not making a profit or the profit's very low, it may not be able to afford to pay the interest. So that's a real problem for companies, and it does make that company itself more risky because it's got to pay interest on its borrowing, on its debt. Now, with equity, with shares, if we raise money by issuing more shares, a big advantage is we don't have to pay interest on dividends, as they're called, where they're shares, because if there's no profit, we just say to our shareholders, sorry, no profit, so there's no dividends this year. Obviously, after a few years, they may get fed up with that, but initially they would maybe accept it if the company is expected to do well in the future. The problem is, the disadvantage with shares, of course, is you can lose control of the company, because by issuing more shares, you are creating more owners of that company, whereby they can then vote, and you may, by issuing more shares, then of course your share of the company diminishes a bit unless you buy the extra shares. So you can lose control. So when raising money, a company must consider these two methods of raising money, debt and equity, but it has to consider that it doesn't want too much debt in comparison to equity. And a company with too much debt, this is all called gearing. That's the ratio of debt to equity, and it's called gearing, and it's a highly geared company if it has a large amount of debt compared to equity as its source of finance. There's one more, and reserves or retained earnings. Now, at the end of the year, the company makes a profit. There's our profit, £80,000, and we can decide what we do with that. Now, the first thing you must do is you must pay your preference share dividend, because they are guaranteed a dividend if there's a profit. So we've got to pay them. We'll say that's 20,000. And then, so that leaves us with £60,000 left over. So we could pay it all to the ordinary shareholders, or we could keep it all in the company as retained earnings. So this figure, 40,000, okay, say we've decided we'll give them 40,000, the ordinary shareholders, which would be expressed as a percentage of their nominal value of their shares. We're giving them 40, so that leaves us with £20,000 left over from profit, which we keep in the company, retained earnings, or that money is in reserve, we're keeping it back. And that accounts for the full £80,000 profit. 20,000 to the preference shareholders, 40,000 to the ordinary, and 20,000 to the retained earnings, keeping in the company. Now, the ordinary shareholders may say, oh, we want all of it. We want the full 60. There's 60 available. Why don't you give us the 60? And, of course, the argument may be then, well, we're retaining the some of that profit because we've got some future investment, This investment will do you good because the future profits will grow, the company will be worth more, your shares, the market value of your shares will increase. And of course this 20,000, it does belong to the shareholders, it's just that we're keeping it back in the company rather than giving it out. So that's retained earnings, which you'll often see on the balance sheet as reserves or just money that's left over in the profit and loss account. There can be a profit and loss account, which is money left over after you've paid these other things. Okay, thank you very much. Bye.